Hello, this is Mike Swanson of WallStreetWindow.com. Got a very special guest with me today. Speaking with David Skarica, runs the website addictedtoprofits.net. How you doing today, Dave?
Good. Nice to be here, Mike.
Well, we were actually talking the other day about doing a video specifically on March 23rd. It has nothing to do with the healthcare thing or Donald Trump or any of this current news that's dominating the news cycle at the moment. On March 23rd, but we were talking about March 23rd, 2009, and lessons that we learned on that date that apply to today when it comes to investing, trading, and managing money, whether it's your own or someone else.
Well, people go, what the hell does that day do? That seems like a pretty, run-of-the-mill day to be talking about. So we'll show you right now. I'm going to get a chart of the S&P up and show you people what happened on March 23rd, 2009, right? So now what we can see here, one second, I'm going to get the thing, sorry.
I got it. I can load it up if you want.
No, it's fine.
Okay.
Oops. Yeah.
But I visited.
Yeah, so you can see the market, which bottomed in early March 2009, was up 7% that day, up 54 points. Now people don't really get too turned on by the S&P.
7% a single day.
A single day. Just think about that. That's like the market falling 1,400 points today. You can see the Dow was up almost 500 points, and the Dow is roughly a third of where it is today, right? So again, that's like it being 1,500 point type move, right? And I remember I was living in Nassau in the Bahamas at the time, and we were putting on a conference, which we'll talk about more in a second. And I was picking up you and a friend who was helping us out with the conference at the airport, right? And I remember actually you guys landed right around the close or near the close, like, there was maybe an hour or two left or something, right? And I was telling you guys, oh, the market's up 400 points or something, and then, and at that time, I don't think you had any positions on. I had gone with some longs then. And then, the market had just started up, and I was actually bullish at the time. I was actually thinking the market could rally for 1 or 2 or even 3, maybe 4 years at that time. Thinking that was the washout, that was the bottom, all this sort of thing. We had maximum pessimism, as John Templeton said, and we could rally. In I was looking at 1,200 on the S&P or 12,000 on the Dow, something like that, and it happening over numerous years. So here we are, 8 years later, and the Dow is 20,000, and the S&P is 2,300, and I don't even think the biggest of bulls during the financial crisis would have told you that is, kind of what would have happened,
Well, there's lots of lessons from that time period because, first of all, as you mentioned, we put on a conference and the people came to that event a couple of days after this March 23rd day. But myself, I was someone that got very bearish on the market in 2007, but I started shorting in the summer 2008, and I made a lot of money in the drop that fall by betting against stocks. But most people were, taken completely off guard by that drop. But it was really that decline in 2009, I think, that a lot of people turned bearish and sold and got out of the stock market. And then they continued to get out in the following years. That's what the money flow data for individual investors shows, that more people took money out of the market than put into it. There. However, when I met you at the airport, as you mentioned, I had no positions because I didn't take profits on the dead bottom of 2008, but like a day or two or something before it, and I just got out, and it was just so I made quite a substantial amount of money. And when you do something in a market, whether it's gold, whether it's oil, whether it's the U.S. stock market, if you find a trading technique or an investing technique that's making you money, it's easy to keep doing it and keep trying to repeat doing it. And that's basically what I did going into 2009. I was like, well, I just made a lot of money shorting. I'm going to try to short again. And that was the mindset I had, even though, and one thing that was happening to me was everyone else was actually getting bearish in 2009. In the year before they weren't, but now they were. So bearish talk was everywhere, and it's easy to be in a trend and have it work for you, and then you get reinforced by everyone else or the media and everything. But I did see signs that we could actually be at near a turning point that would lead to a bottom. But and that was that a lot of individual sectors actually started to hold up, even though the market was going lower in the first couple months of 2009. And world stock markets did actually start to perform better than the U.S. China, for example, did. Asia, and gold, of course, did better than the U.S. stock market in the first couple months of 2009. Gold stocks did a lot better, which was something new. And it was a sign that a turning point in the broad market could actually, or a critical bottom could be had. But I didn't myself heed that. And that's a lesson I have learned over the years, is you got to rewatch for turning points in the market. When something's working for you, that's when you've really got to be on guard to watch the most. Right now, we're we're in a mania where everyone is bullish. No one's worried at all about the market. The market's gone up for years. And now we've had this tremendous rally since the Trump election that even though it's the last peak in the Dow and S&P was made at the beginning of the month, and we're lower from there, and we even had a big down day this week, and now there's actually talk that maybe Trump won't be able to do everything he's saying, which is the supposed basis of the rally. None of that really matters. No one's worried. Investors' intelligence is near 60% bulls. The VIX is super low. That down day the other day was a 1% down day. That was the first 1% down day in 109 days for the S&P 500, which is stock market history. Yeah. So we're in the complete opposite environment of that March 2009, where everyone was bearish. Now everyone's bullish, and they can't conceive of risks in the stock market, or the stock market can decline. Just as back then, no one wanted to buy stocks. And I admit I was one of those people. And I've learned from that lesson to make sure I don't get into some rigid type of thinking again.
Well, see, I'll tell you what happened to me. You made money in the crash. And what happened with me is I made much more money than you in the bull market of 2002 to 2007, but it wasn't because of the stock market. And the reason was I was very active in the junior mining industry. So we had a stock called Paramount Gold. And I bought a seed financing, which is the first financing that they do in venture capital to kind of seed up a company with money. So this stock came out and the seed financing is, in cents, right? Like well under a quarter a share. And the stock comes out and it goes to $4 a share. And I have this huge profit. So then with me, and this happened in late 2005, early 2006. So with me, I'm like, well, holy crap. These financings, I've already made some money in some other ones, but this one really. So I kept doing financings, and during 06 and 07, they did fantastic. And I was also in gold stocks. And I was like, my experience, you talk about what is working with gold stocks in the prior bear market was, well, in 2000, 2001, 2002, gold stocks went higher. So even if there is a big market tank, and Mike can tell you, I wasn't a bull. I warned Mike. I was the first one who told Mike about the housing bubble in 2005. Just because of what had happened in the early 90s, there was a housing bubble and bust in Toronto from near where I'm from. And I'd seen it. And then I went to Florida, and I'll tell a funny story about that in a second. We'll talk about I got some funny stories to tell you too. So I won't just take this seriously. Right. But anyhow, and I was sure. It was actually, I kind of went to Florida, and like the guys in the Big Short, when I went down there, I was like, yeah, it's totally a bubble. Right. In mid 2005. So I really thought that the market could roll over, but I was like, because like you said, what had worked for me was being in precious metal stocks, being in precious metals, and then they all crashed with the market, and I lost a lot of money in 2008, 2009. And I was still active when the market came back, but I didn't buy as many junior stocks. Actually, one reason I bought my house in 2011 was because, okay, I just don't want to be, I was always a renter until then. And I was just like, oh, I don't always want to be a renter and not have equity in anything and just being, mining stocks or whatever, even if I'm hedging in a downturn, right? I wanted like another asset. So anyhow, with all this sort of thing, so I did the same thing. I'd been making money one way in private placements, in precious metals equities. I kept doing that. And then it slapped me in the face when the market declined, and I learned from that. But as you're saying, in 2009, so we had this conference in the Bahamas, and here's the interesting part about the conference. And this is what shows you look at. You got to look at your psychology and don't think this is as easy as you think with the markets, okay? It's easy now to act like, oh, I own Apple, I've been bullish, blah, 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 I've made money, the bears are idiots, right? In 2009, Mike can tell you this, at the conference, I was like, and I'm not saying this to pound my chest, I'm just saying this, I was like the only person bullish at the conference. And I wasn't like huge bullish. I didn't think this 8-year thing was going to happen. But I thought that this was like the 74 or, like 29 bust. We just saw a huge bust, and we would see a reaction rally or like 37, that would last a couple years, maybe 3-4 years at the most. So that's why I was bullish, right? And everyone there disagreed with me. They all thought the market was going to continue to go lower. And what was interesting is all these people, like Mike was like the king of the show, right? Like everyone loved Mike because he had made all this money in the downturn and all that sort of thing. And I just figured, all Mike's subscribers, they all made money. And I didn't realize till years later when Mike told me, none of those people had made money, okay? Those people had all turned bearish right at the effing bottom, right? And then decided to short stocks then, right at the bottom after seeing Mike make money. So again, psychology is an interesting thing that now everyone's bullish, money's pouring into ETFs. We'll tell the stories in a second. But exactly then, everyone was bearish. Everyone thought the market was going to keep going lower. I remember one of my contrarian indicators too as well was they had a thing called a night with the bears in June of it was in May or June of 2009, and it was like a small arena in Canada that fits like thousands of people, and that Nor Robini was one of the speakers, and Sprott was one of the speakers, and it was another Wall Street analyst who had been a big bear. And one of my friends even attended that, and I told them that that's the bottom. I said, you got these 3 people charging whatever $100 a ticket for this thing, and they put 5,000 people in this arena. Come on, man, that's the bottom. That's a total contrarian indicator. And of course, it ended up being the bottom, and this thing rallied for years and years and years. So that's just what we tell people. It's just like now it may seem easy. It may seem like, this market's gone up for 8 years. You were stupid if you were a bear, all this sort of thing. But at the time, it was a lot different. And what's interesting is I just recently found there was a show they had for a while called Wall Street Warriors. They did 3 seasons of it. But the 3rd season was never shown. The 1st and 2nd seasons were. And they took place during 2006 and 2007. The 3rd season took place during 2008, during the crash. And the last episode, which I have up here, so you can watch this on YouTube, by the way. If you just type in Wall Street Warriors season 3, you can see it. And it's not really a great show or anything, but what I think is interesting about it is during the last few episodes when the crash is happening, it's like the financial advisors are talking about how they're like 78% or 80% in cash. And the people are talking about how no one's got faith in the market, and these people have lost all this money, and they're talking about the market breaking that 2002 low and going to multi-decade lows. And you can just see everyone is bearish. And there's a guy who raises money for hedge funds in the show, and they've got some weird convoluted patent thing for making money that's what they invest in at the bottom. They don't just say, hey, let's start up a hedge fund that's bullish on the markets because we've had a big crash, right? No, they do some weird things. They don't think they can make money in regular investments, right? So it's just a lesson is like, you just look at this thing and the psychology that's in this TV show again, compared to what we have now, it's the polar opposite. It's 180 degrees. It's just like, and of course, no one then knew where the exact bottom was, and the market kept falling into the March of 2009. No one now knows, is this thing going to top March the 1st? Is it going to go up until May, until July, until next year? No one knows, but we do know that we're really, really near the bottom. And here's the last thing I have to say about this, because I was bullish in 2008, 2009. I was never really, I wasn't one of these guys who was bullish the whole way down, but I was never like real bearish either. I was just kind of neutral, watching, just thinking gold would be my hedge, but that didn't happen. But what I'm saying here is, in 2008, at that time when I was getting really bullish, the S&P is what, in the 800s, right? The Dow is about 8,000. They still had another drop. The S&P went to 666 at the bottom. The Dow went to like 6,500, right? You can see that actually right here from my chart, right? Yeah, the Dow went to 64, 69, and so what you're seeing here is this rollover, and this rolled over one more time, like in November. You could see the bottom was like 7,500. It was really trading around 8,500 most of the time. Still went really another 2,000 points lower. But if you had bought here, if you see what happened over the next 3, 4, 5 years, 8,500 looks pretty good, right? So that's just what I'm trying to say is, like, just like then, you shouldn't be concerned with the market dropping another 20%. If you've sold out, or you sold out at 2,000 the S&P, or 1,900, or whatever you sold out at, and I really turned bearish around 1,900 to 2,000, don't be worried about if it goes up another 20%, because it's impossible to time this. And just like then, getting in within 20% of the bottom was fine. Now getting out within 20% of the top is going to be fine, because we are going to have, in my opinion, an epic bear market. And I'm not a doom and gloomer. I'm not someone who tries to put fear into people. But look, all I know is this. This is now the second longest bull market in history. The only one was longer was the 90s, okay? And the only two that are relative in terms of length were the 1920s, right? And the 1990s. And both of those were followed by horrible bear markets. In the case of the 90s, you had two terrible bear markets in the early 2000s and 2007, 2008. And in the case of the 20s, you had two brutal bear markets in the early 30s to 32 and 37, 38. Okay, so all we have to know is this: when the markets have been this overvalued and in a bull market for this long, the only other two times in history, the market basically had bear markets where it fell 50, 60%.
Well, it's very there's one problem people have. One of the big mistake. If there's one mistake people make, I think they focus on one market. It's not. I mentioned before, they focus on, you can get trapped. You focus on one trend that's working for you. For me in 2008, I made money shorting, and then I continued to focus on shorting when I should have adapted. I did adapt when we left in March of 2009. After that conference, I came back home in April. I actually tried to short again because it rallied a little more, and I thought, oh, yeah, I think it went up to the 150-day moving average even. But I put a really tight stop loss order and got out. I think I may have tried one or two more times more. But I didn't. I think you tried
in this. I'm not trying to point out, because I've lost money plenty of times. Don't get me wrong, right? I remember you tried in the summer because we were at a conference that we were at Freedom Fest, and that was the summer of 2009. And I remember you just telling me over breakfast, "Oh, I just closed out my short," right? And it was a day when the market was coming off. But here's the thing: I remember shortly after that you went long.
Yeah.
In 2009, and the market, went up for the next couple of years.
That's one point. Well, that's just what I know why I'm saying this. Okay, so yeah, that's what I did, and I told people I'm going long, and I was buying these different stocks, and at the time I had a message board on the website, and most of the people on that message board, what they had done is they were trying to trade these bank short ETFs all the time, not really trying to invest in them or something, but just trying to trade short bank triple ETFs. I can't remember the ticker symbol. And they were doing that for a couple years. So that's how they were trying. They weren't trying to buy stocks or invest in the stock market anymore, but just try to trade these triple ETFs. And then so anyway, that's what I think. So that I think they're making a giant mistake. Obviously, they weren't all doing that, but a good portion of them were doing that. Now, what I want to say is what leads to people making that mistake, I think, is one giant mistake, and that's to focus on one market. And so what will happen is that market will work for you. Then when it stops working for you, you say, oh, now I have to become a trader, or now I have to short it, which ends up not working too often.
Yeah, like for example, you had you're mentioning you had a message board, I remember, on your website for a while. And these people were all gold bugs and gold bulls. And then when gold collapsed, all of a sudden in 2015, 16, they were trying to trade the dust and the 3X bear ETFs, or even just trade the JNUG, the bull. They were trying to trade these because they didn't think you could make money in gold on the upside anymore. And of course, trading the dust in 2016 was one of the worst investment strategies you could have ever had, because the gold stocks had over 100% rally, and that thing went to dust, right? So you're right. That's what people really try to do is they become bullish, and then they become they get scared, and then they become bearish, and then let's say the market then starts to rally or whatever. After they're bearish, they become traders. They try to get in and out, try to make a couple points here and there because they're still in shell shock, from the financial crisis. And maybe that's the mistake I made with this bull market personally, because if you go look at it, if you go look at the investment sentiments kind of stuff, like I don't mean investors' intelligence, I mean the macro kind of polls, like people's confidence, that sort of thing. It was still really low going into 2011. So that was kind of the sign that it was going to be more than a 2 or 3 year bull market. And, here we are 8 years later. Now, by the way, now those confidence polls are sky high. They're the highest since before the dot-com bust. So that's using that as a contrarian indicator would probably mean we're near top as well too. So, but you're right. That's kind of what people do. Then when they get scared out, they just want to take a few points here and there and that sort of thing. And like I've done that too. Like if I've lost money in a sector or stocks, then when I get back in, say the thing jumps 20%, yeah, you want to take some of that profit instead of maybe letting it ride because you have been burnt,
But I think like right now, if gold, you sort of see the same thing where it may not be at this point that people are trying to short gold anymore. But now they don't really have any faith that they can invest in it because it's only gone up for 1 year. Then it gave up a lot of half the gain. So, and it's so volatile. So a lot of people just want to trade it instead of hold it. So, but the same thing was going on in the stock market in 2010 or 11. People had very little confidence in the stock market as an investment. You had that flash crash event and so forth. But now we're in a moment in which people really aren't trading the market. They're not trading the Dow and the S&P 500. It seems like now they're truly trying to invest again, or new money's investing again. You see that in the data of the amount of money going into these ETFs, and yet trading volume is lower than it was last year. I think that indicates that people aren't trading so much. They're just buying and trying to invest in it now, when before they weren't interested in investing, they wanted to trade. But I think
what's going to be, a lot of times you can just look at the charts to see how funny this stuff is. I'm going to put this on a linear scale so you can really see it, right? The real moves, right? The moves. But like what happens is now I'm going to get even a longer year chart. I'm going to get a 20-year chart so people can really see, right? Like in retrospect, we look at this and this big decline, right? In 2008. And you look at that, you kind of laugh at yourself almost. You're like, yeah, people were all panicky there. Like, how much lower was it really going to go? right? And look where we are on this chart now. It's almost like you turned 2008, 2009 upside down.
Yeah.
And people want to buy ETFs, but it doesn't seem ridiculous. It's not mocked in the press. It's not like, it's not like this is stupid. The market's 3.5 times its low of 2009. What the hell are you doing buying it here, right? And then, but no, it's like people, like we have a few people that are kind of nuisances. And they're these big bulls, and they write us all the time, and they're just as gun ho now as they were then, which is funny because even though I was bullish on gold in 2011, I took a way more tepid tone in terms of the amount of investments I made, the amount of stocks I recommended, because I just figured gold was a little overheated and that sort of thing in the short intermediate term. What's funny about these people is like you're talking about these flows into ETFs, people doing long-term investing. Now they're more bullish than they ever have been. And I think another mistake, we're talking about making mistakes you can do, is I think you can't get caught up into politics, because a lot of people do, and they think there's going to be this big boom because Trump is going to cut taxes and there's going to be lower regulation and an infrastructure program and all this crap. And he's a businessman, that's good for stocks. But look at Obama, was almost viewed as like a socialist. Well, look what the market did under Obama. Now, I think it's bullshit because I think all they did was cut rates to zero and print tons of money, and they pumped the market. It's not like Obama's some genius or something. But what I'm trying to get at the same time here is Obama is viewed as unbusiness friendly, but the market has this huge 8-year run. Bush is viewed as business friendly, and the market dumps in 01, 02, and then dumps again 07, 08. And so just because you can't, that's another trap, is to get sucked in to the politics. I actually see the politics as a contrarian indicator. You look at the only other stock market move that's similar to this from election day to the inauguration speech was Hoover, right? So that tells you where it might end up. and so I think that's another mistake, that people get caught up with the politics and maybe the guy does philosophically what they agree with, and they think that's going to be good for markets. But the most important things in markets are sentiment and valuation. And both of those two things are really stretched to the upside.
Well, I think, I've been saying, people make these mistakes and they do this and that. The problem they make mistakes is because they're people just like we are. And the thing is, if you're fully invested in something, whether it's the stock market or gold or oil or real estate, it doesn't really matter. If all your money is invested in one thing, it's basically impossible to be objective about it at all. And look for confirmation that you're correct. And when you see signs that you're not, you try to ignore them until it's too late, and then you become, the trader or make more and more mistakes. You stop investing when the bottom is in, and so forth. And I think the only way to escape yourself from getting into that trap is to invest in multiple markets and multiple trends. So that's something, that's the lesson I took myself from those experiences of 2008, 2009 and beforehand, is not to be all in gold or all in the stock market or all trying to short, but put a portion of your money in one thing and something else that aren't trading together. Then you can be more objective about it. So that's why, like right now, I don't, I've got some of my money in gold. Last year, I was able to buy some stuff after the election. I bought the bank ETF and some infrastructure ETFs that week, and they all went up crazy. But I didn't have all my money in it. So a few weeks ago, I said, well, I think it's gone up enough, and I'm going to sell. I can do something else now. I'm not going to worry that, it's going to go up another 10% or 20%.
Yeah.
Here,
see,
I got
and the way.
Sorry. Yeah.
Well, the way I did that was after the election, because I have been bearish for a little while here. I realized, okay, well, there is going to be this Trump trade, whether it's just totally discounting what's not going to happen or discounting what is going to happen, whatever. But I was just like, well, probably first of all, in the last 2 months of the year are usually pretty bullish months, or if the market doesn't tank, people are chasing performance or whatever, right? Companies are buying back stock to, try to pump it to get their options or whatever the case it is, but it's usually bullish. If the market usually hasn't tanked by the end of October, November and December tend to be bullish. So I was like, well, now we got this election. People are gonna be excited about this businessman being elected. So, all this sort of thing. So I bought about 5 or 6 stocks. A couple of them were energy stocks. 2 of them were energy stocks. 2 of them were tech stocks, and 1 of them was a healthcare stock. Now that one of the tech stocks and one of the healthcare stocks did poorly. One of the tech stocks did pretty well. One of the energy stocks did okay, and one of them did really well. It was up 50 or 60%. And overall, if I added it up, I probably made a little money off the trades. But I did kind of the same thing. I was just like, well, look at it. Nothing is going to happen on the bearish side probably for a few months. So I can do these trades, and then just so you know, I'm basically out of all of them now. The healthcare stock and one of the tech stocks, I have a little small position left in, but very small, So, that's kind of the way I did it. So, well, here, just to change it a little bit, I'm going to tell you some funny stories, right? Okay. You might as well have some fun here. Okay. So here are signs, and this pertains to a few things I've just had happen recently. Okay. Which I think are very funny. In 2005, when I told Mike that real estate was a bubble, that's when I moved to the Bahamas. And that summer, around July the 4th, right? I went first to Florida, and then I flew over to the Bahamas that time. So I fly into Florida, right? And I think somehow I got a newspaper, and I was going in the cab on the way to the hotel, and my dad was with me. And we had this Haitian cab driver. The guy barely spoke English. And I was just looking through the paper, and I'm looking at the real estate prices. And I'm like, oh, my God, like a condo here is $600,000, right? And I'm asking the guy, and he tells me his little house, which is probably in, a rough area of Miami, is gone from $65,000 to $155,000, right? And he's going on and on and on about it. I'm like, this Haitian cab driver is like shoe shine boy, right? And then my masseuse starts talking about real estate. I'm like, that's the top, right? And in the 90s, all these people got into day trading and all this sort of thing. So recently, a few things happened. I live on an island called Eleuthera, and Mike's been visiting me. It's really small. In terms of population, it's kind of a bit of a backwater, which is why I like it. There's only like 10,000 people who live here. It's not like Nassau or, Nassau, is an offshore banking center too. There's banks there. It's like a rural place. A lot of surfers and hippies live here. So I have a friend who's a cook, and he flags me down on the road. He's like, yeah, man. I want to do an investment with you. Like, I see that the market is doing awesome. This is like a few weeks ago, right? Oh, yeah. It's doing really good. I want to get in. I'm looking at this guy. Like, this guy's a cook. He doesn't know nothing about investing. And, he's telling me how he wants to get in to the market, right? And then I had a family member stay with me recently, okay? And this person stole at the bottom in 2000 and this person sold at the bottom in 2008. And I told him, I said, don't sell. I said, look, people think I'm some doom and gloomer because the first book I ever wrote in the late 90s was predicting a bear market. But I'm like, this is the bottom. This is the panic. You buy panics. You don't sell them. And of course, they sold. Now, the same person is invested in these annuities that are linked to the market. So either you get your capital back or you get the gain of the market, right? And every day they would ask me what the market's doing. What's the market doing? What's the market doing? So this person who was like a total contrarian indicator in 2008 is now looking for the market to bottom here. Sorry, the top here. Keep going up here, right? So, and then my kind of story, I'm not going to say it because it's a friend of yours, right? But you had a story that was really funny about this too. So now I'm seeing. And maybe that's why the market didn't top in 2015 or 16, like when I thought it was going to top.
You saw it.
because I didn't see these mania stories yet. I didn't see these people thinking. We didn't see these. And then you see in the data, the record ETF flows, the consumer confidence going through the roof, all that sort of thing. You know?
Yeah, no, it's something else, and never thought we'd see anything like it again. That's for sure.
Even the guy who built the Cove, that's a Mike's been to it with me. It's a really nice resort here. And he's a really smart guy. He basically had a garbage company in New Orleans. I'll tell you a quick story. Anyhow, these guys made hundreds of millions of dollars. He rebuilt the Cove Silver for a lot of money, but he's got, I just watched it last night. He's got a show about flipping houses on CNBC right now. And he's made tons of money doing this. So I'm not saying anything with him because he knows what he's doing. But I just kind of thinking, well, the fact that they're putting a flipping housing show back on, we had a housing bust 10 years ago, probably means there's interest in it, and you're probably near another top in housing, So, and like I said, like with that Haitian cab driver, look, I met that guy, like I'm telling you, it was like right here, right in the middle. Look at when this Dow Jones U.S. Home Building Index would have been 1,100, right, and it went to 130.
That's crazy. That's crazy. That's the way things happen. It's a strange, that's what makes the markets fun, I guess, or interesting. And
again, if you want the perfect example of that, look at it. 2005. No one thought housing could go down. Everyone was bullish on it, and we all know subprime, but just forgetting the subprime and how that blew up the markets. Look what happened to the housing stocks themselves. They went down almost 90%. So, and by the way, that's also a lesson on the downside, just so you know, is that when something goes down 90% or 80%, start buying it, even if it goes down a little lower, because usually it's going to have a good multi-year rally and it's going to go up hundreds of percent. In the case of these housing stocks, they've actually gone up fivefold from their bottoms in 2009. And even though they lagged the market for a few years, actually, the S&P is only up 3.5 times. So they're up more than the S&Ps in that time frame.
And that's because they crashed, as you're saying. They fell 90%.
Yeah, exactly. They fell 90%.
The casino stocks are the same way. The Winds and Las Vegas Sands, they were priced to nothing back then, like $5 or $10. Now now Winds over 100. So
Las Vegas Sands went down to almost $1, and now it's $55. It was up to 75.
Yeah.
So that's another lesson too. And by the way, in my newsletter, I plan on doing this when this is actually, this is actually. Oh, I'll be perfect honest. This is actually personally, my this is personally. Oh, sorry, I didn't do the screen share. I did. Did I?
Oh, I'm looking at you.
Okay, I didn't do the screen share. One second. Let me just quickly show. I thought I did it. I guess I didn't do it. This is here what I was talking about with the Dow Jones Home Building Index. You can see the 1120 right when I met the Haitian cab driver, and then you can see the 130, and you can see, like I said, it's gone up 5 times. The S&P's gone up just over 3 times. Okay, so but anyhow, that's what I plan on doing in my newsletter. And like one of my selfish reasons for wanting a crash or a decline is that you're going to get, this is where we're going to make money. You're going to get these kind of opportunities in this, or this is Las Vegas Sands that you're talking about. This stock goes to $1.07 a share and goes to 75 and 61. Like another one was Crocs. This is the maker of those like horrible plastic shoes, right? But you can see Crocs goes from 75 to 79 cents and then goes to $32. Like this is how you really make money. This is actually totally George Soros's theory of reflexivity, that you reflex too much to the upside and then you reflex too much to the downside, and then the market has to reflex from that, and then that's where you can get. And look, you don't even need the stock to go back to its highs or whatever. It's just, you don't even need to get out at the top. If you bought Crocs at, say, you didn't get the bottom, you bought it at 2, you could have sold it at 20. And make 10 times your money, So, and that's realistic, I think, to do that sort of thing. So, and just so you know, sorry, just so I can end off on this point, you can see Crocs, when the stock market, say, was only off 7 or 8% in 2008, Crocs was already off like 60%, 70%. So I have stocks like that I'm watching right now that are off, 70, 80% from their highs. And I figure if you do finally get a bear market or crash, they'll all be down 90, 95, 99% like Crocs. And then when you get the rally, these are the kind of stocks that are really, really going to lead. They're not just going to go up 20 or 30 or 50%. Because let's face it, if people do buy something in a crash, they're all going to want to buy Apple, right? But you don't want to buy Apple in a crash. You want to buy the stuff that is really beaten up, like Las Vegas Sands or Crocs.
Right. Well, that's that's the future right now. We're still drifting around on no volatility at high levels.
Yeah. Well, you're right. Right now, the market's still dead, and everyone's still bullish, and everyone still thinks it's going to keep going higher forever.
And they're trading those symbols right there, the on the screen.
Oh, well, yeah, Amazon.
Yeah. Well, I'll wrap up, or I'll let you go. We've been talking for about an hour, and we'll do more of these type of interviews and videos in the future. Thanks for taking the time to talk to me and everyone else.
Yeah, thanks for having me.